recording now. Yeah, there we go. Now we are recording. And I'm Tim Quast with Market Structure Edge. Thank you for coming today. Today is November 13. Wow, it's hard to believe. Which means options expire next week. We may come to that. And along with me is Brian Wilson, market strategist. And we like to divide and conquer on this. And we were just talking about just trading notes on the things that we want to cover today. I will go second because I went first last time. And you might have noticed that I have done the notes this week. It's because I'm going to be out next week. So I did a bargain with Brian. I said, if I take them this week, will you take them next week? I'm going to be out. I'll be out Monday through. I'll be back Friday. It's my wife's birthday, and so we're headed to Cabo for a last splash of sunshine before the long steamboat winter. And so Brian's going to cover. And speaking of which, Brian Wilson, over to you.
Thank you, Tim. Good to see everyone. As Tim mentioned, I went into the weeds for about an hour before the meeting. I'll go into the weeds a little bit, but I'll try not to make it too dangerous for you guys as we go there. Hope you guys are doing well. Well, I'll go ahead and share my screen. I did want to start with, I'll call it big tech above 8. So let me show you what I'm talking about here. So one of our portfolios that everyone has is called our big tech portfolio. Most of you are familiar with this. It constitutes, I mean, depending on how you're looking at it, 35 to 40% of the S&P 500. And here are the components in big tech. And over time, what tends to happen is if big tech is doing well, the market tends to do well. If big tech slides, the market tends to slide. One thing that I had mentioned the last couple of meetings is that another dynamic is that when big tech tends to get above 8, and that happened here a couple of weeks ago, market returns tend to slow down. And you can see what was happening going into big tech getting a little bit stretched. So big tech is rallying. Look at the market on this side. SPY continues to do well. When big tech gets above 8, market returns tend to slow down. And let me show you what this looks like. This is over the last couple of years. January 2024 going through the present. And what you're looking at here are returns. So when big tech does get stretched, what tends to happen in the market? Well, big tech above 8, market returns tend to be about negative 60 basis points. What tends to happen during the next week? Does the market tend to fall apart? No, it doesn't. Even with this last one, we went above 8 at the end of October. It went down below 8 in early November. Market returns during the next week were 1%. And you can see over time, that's pretty much what the market tends to do. So this last time was pretty much right in line. Market did fall just a little bit more than it normally does. That brings up my next topic, though, is big tech can get stretched, but then what happens when it falls below 5? So 10-point scale, our demand algorithm, big tech in particular, once again, constituting 35 to 40% of the S&P 500. If it moves below 5, what tends to happen there? And I am going to go into the weeds just a little bit here. Hopefully there's a reason for my madness. What I'm going to show you is what's been happening really the last 4 cycles or so where this has occurred. And I'll show you what's happening in the broad market at the same time. Try not to make you dizzy here in the process. So we'll start back in December and January of last year. Let's go take a look at the broad market and show you what was happening at this time. Once again, the topic is big tech moving below neutral. What tends to happen in the market? So this is the time frame that we're looking at right now. So big tech went below neutral back in December going into January. What happened during that time frame? It returned about 80 basis points. And you can see what happened there. The whole market just kind of went sideways for a period of time. And I just decided I'm not going to take you into the weeds. I'll just kind of share with you what happened in the data. Then you won't get dizzy and you won't hate me so much. February going into March, big tech went below neutral. What happened in the market? Well, the market went lower. In fact, during that stretch before big tech stabilized, the market lost about 4%. The next time that it happened was in April. Market lost about 6% before big tech stabilized. Briefly in August, I think it was this little dip right here. We were basically flat by the time big tech stabilized. And then once again in early October, you can see it right through here. By the time big tech stabilized, we were actually up by about 80 basis points. What's one of the takeaways? Well, I'll share with you what was happening in early October. Maybe we can make an observation here. I keep lots of spreadsheets. John Cook loves to keep lots of spreadsheets. Sometimes they're helpful, sometimes they're not, but over time it kind of gives me an idea of what's going on. I like to keep up with trends in the broad market and big tech as well. Notice in early October, I mentioned big tech was a little bit weaker. What was happening in the broad market? Well, it was actually doing okay. What happened from a broad market perspective? We were fine. We were up by 80 basis points. That kind of sets the tone for where we're at now, though. And Tim and I will get into this when we look at the path ahead here in a few minutes. If we look at big tech right now, it's starting to weaken. Where are we from a broad market perspective? Well, we're weak as well. So it's not a great setup. We're below neutral. We for now we stopped moving lower, but as you can tell, it's not a great setup even for broad market setup or for big tech as well. I did mention some of the larger components, and this is what the top 15 looks like right now. S&P 500, 45% of the S&P. What I want to take for just a couple minutes is just show you what's happening behind the scenes with these guys. So NVIDIA, Apple, Microsoft, and Amazon, 25, 26% of the S&P 500 at this particular time. The question is, can we glean anything when we look at the supply and demand setup for these guys? And what I'll do is I'll take us back for a year on all four of these, and we'll try to get an idea, where are we right now? Is there any way to predict, what's going to happen next? So NVIDIA, you can see that demand is sliding. One thing that NVIDIA has shown during this recent rally, it's never gotten down to one. And that's the case right now. I think we're at 2618, somewhere in there. But what did happen at the beginning part of the year, we were hitting ones. And what was happening for those cycles? Well, when NVIDIA was hitting ones, well, it tended to be weaker. And one takeaway from the recent stretch of the last 5 or 6 months, well, demand has stayed pretty strong, during that time frame. And once again, we're never hitting one. The takeaway here for all four of these names that we're going to look at, are we looking at a January through April cycle where, demand was weakening and, these stocks were doing poorly, the market was generally doing poorly, or is it going to be the May through November cycle where the dips get bought? That's kind of the thought process to keep in mind. But right now you can see NVIDIA sentiment is sliding. It's been bought recently. Will it get bought again? Don't know right now. We look at let me take them in order here. We'll look at Apple. And once again, take that back on a 1 year look. And you can see recently, Apple tends to stay above neutral. Once again, when the last few months, when sentiment does get below neutral, it becomes a buying opportunity. Gets below neutral, becomes a buying opportunity. That was not the case for January through April. April, when it moved below neutral, well, Apple fell apart. Once again, which one is it going to be? Microsoft. Same look, take it back a year. And you can see that Microsoft sentiment has been washed out all the way down to 1. We really have not been there since last April. Um, a little bit of a different tell here, isn't it? If we look at that January through April period, Microsoft kept coming under pressure when it got down to 1. Of course, it did get bought in April, just like most of the market got bought at that time. So a little bit of an outlier here with Microsoft. It has not been back to 1 since April, as you can see. And last one is Amazon. And you can see Amazon has actually stayed pretty strong. It's just coming off a 10. It's moved down to 8 right now. Similar story to everyone else that we've been looking at, though. You can see it really got washed out for a period of time there in April and March. And to me, for Amazon in particular, well, it depends how far sentiment falls. It's still strong at this particular time. So once again, kind of the big picture perspective, will this dip get bought? We saw it repeatedly from May through now, whenever there were any dips in these prices where they did get bought, or does it become more of a January, February dynamic? And of course, if we're looking at January through February, what was happening from a broad market perspective? Well, the broad market was either moving sideways or it was moving lower. Been very different trading from May going forward. Speaking of the broad market, I'm going to bring this look back. I believe it was last Friday when I touched on this subject, and it's a little bit hard to discuss in a market desk note. But what I want to share with you here is this cycle right here. And if you drew an arrow, you can see that demand cycles in general have just been getting a little bit weaker over time. What did we tend to see in 2024? It's very consistent, this ebb and flow of demand cycles, but they were very consistent. You could make the same observation for most of 2023, very consistent demand cycles. Notice what happened here towards the tail end of 2024, 2021. You can really see a weakening in those demand cycles. Now, these things don't manifest immediately. It took about a quarter for that to manifest. But what did we see then at the beginning of the year? Well, basically to the day we got to the new year and we started moving lower. I don't know. I'm just kind of musing out loud here, but could we see something similar developing now where we are seeing these weakening demand cycles? To me, in the data, the last time I really see it occurring, I have to go back to the latter part of 2021. So it's just something that I'm keeping an eye on right now. To me, it doesn't mean that the market is necessarily just going to go into a bear market right now. We could have similar trading to what we saw back then, and then maybe we have difficulty as we move into the new year. That gets more into the look ahead. But so I'll stop for now, Tim, and then we can kind of discuss how to trade this market maybe together a little bit later.
Okay, thank you very much, Brian.
Yeah.
Yeah, we'll I've got that as a point of discussion as well. Yeah, I mean, we have these conversations all the time, about what are the data giving us a pattern like this period in time or like that period in time? And look, no one knows. We certainly know what the trends are and what those indicate. But a demand supply pattern is not a technical pattern. And one of the things I wanted to talk about, particularly if you're new, and you think, well, we sound like we're speaking Greek here, is to explain some of these things that we use. If you veterans will bear with me a little bit. One, I wanted to talk about. I'm going to put my second item first here, which is what is demand. And John, you've mentioned this before too, that it would be helpful maybe to detail this. I will use an analogy, and I'll tell you specifically what we do with this, and I will share my screen. The analogy is if you're running an index fund, and your aim is to approximate the performance of the S&P 500 in a model. You would want a statistical sample of that model that would give you a very high probability of replicating its performance. By the way, you can do that. I could tell you now there are 25 stocks that are almost a near perfect match for the performance of the S&P 500. We think about it from the corporate business side because we want to help public companies that want to be the benchmark. How do you match the benchmark? Well, there are characteristics in the data that you would want to reflect. And that leads into demand. The demand is like that. It's like a statistical sample of the behavior of what's occurring in the market that helps us to understand if people are buying or selling. And even to some degree, what kind of people, quote unquote. We think of the market as comprised of four big things. There are the stories of public companies. It's one input. If you look at the S&P 500 is, call it all the same as 95% finished reporting earnings for the third quarter. And they're good, up 13% year over year, 80% so 80% of companies, give or take, taking an average, had surprises on the top line, revenue, and the bottom line, earnings. And so then you would look at the market and you'd say, well, if earnings are awesome, why is the market down? Why is the S&P 500 down 110 points right now? It could be a one-day event. But it reflects this reality. There isn't one purpose in the market. There are multiple purposes. Story, the fundamental characteristics of businesses that people buy, the Warren Buffett, Benjamin Graham model is one thing. And it's a very good thing so long as it's the dominant determinant. It is not the dominant determinant. It is 10% of market volume. Buy and hold money, buys and holds. We have a market that is riven with other purposes that have shorter horizons. And so you have to take that into account too. And so our model that we call sentiment or demand is a model that takes into account different purposes. So there's story, then there are characteristics. So most of us know who BlackRock, Vanguard, State Street are. I'm using them as a type, but they are, broadly, we could call them asset allocation money managers. They tend not to pick stocks. They tend to allocate assets on a more broad spectrum to different asset categories or classes. And one of those is equities. And they are where active money is about, call it 10% of volume. Passive money is over 25%. It's more than 2.5 times larger as a demographic in the markets than stock picking. Therefore, you cannot, like, you look at CNBC. Look, I'm on it periodically. I know a bunch of people there, and they have to focus on what they focus on. But you would get the impression if you watch CNBC that everything in the market is about fundamentals. No, 10% of it is. But money that runs models does not have any reason to come on a news program and talk, because that's not what they're in the business of doing. They're in the business of tracking a benchmark, at which they're very effective at. 98.5% of stock pickers in large cap growth, which is what Brian was covering. Big tech is large cap growth. Failed to beat the benchmark the past 10 years, Morningstar data show. We read all that. We consume all that data so we can keep up with these trends, and we model a lot of this data. And so that is a big motivation, and you have to understand it's the one that determines a lot of these cycles that you see, a demand cycle, a supply cycle, and I'll get to it. Then you have price. Because we have a market that is a data network where the NYSE and its 5 different exchanges, and the NASDAQ and its 3, and the SIBO, what used to be called the Chicago Board Options Exchange, has 4. Then there are a bunch of independents. There's the Texas Exchange. Well, all of these markets, all their servers, by the way, are in New Jersey. The servers aren't in Texas or some other place. They're all in Mahwah, Secaucus, and Carteret, New Jersey. And they're all interconnected, and data travels at the speed of light, basically. And prices are set by firms like Citadel. And they will change the bid and the offer because it's all interconnected, and the rules require that all prices, all trades match. It doesn't always happen, but that's the regulatory requirement. The imprimatur, the purpose of the regulation is for prices to match between the bid to buy and offer to sell. That is a major part of the market. Half the volume is that. And then you have derivatives. 0 days to expiration derivatives have $1.5 trillion of daily notional trading volume. The stock market is about 1 trillion. It's more than the entire stock market. So you cannot look at the market and expect one of those things alone to price. It may periodically. We even have measures for that. Well, where's this behavior pricing the market versus that behavior? But you put them all together, and that is broad market sentiment for us in the S&P 500, because it's about 90% of market cap. And so what we do is we calculate the contribution of those behaviors as percentages and their impact over the short run, over about a 5-day cycle, on midpoint pricing. Why midpoint? Because most orders are derivations of midpoint. Most orders are trying to get between the bid to buy and the offer to sell. Okay, well, it's mathematical. 0 days to expiration options, if you're hedging gamma, cannot be done manually, not successfully anyway. The decay rate is so fast. The arc of the entire day is a day, right? That's all. The option goes from worth nothing to worth something to worth nothing in that period of time, right? Well, how would you do that as a human being? And so a lot of that is machine driven. It's why it's very difficult for you and me to compete with that. And so these things all factor in. You can't, if you have an integrated model, the beautiful thing about this is not fundamental. It is not technical. Those are inputs. Those are purposes behind that order flow. But for us, we just want to measure how does all that order flow conform with the rules, and we normalize it to a 10-point scale. So a large basket of 500 stocks here is not going to go to 10. A smaller group will, the smaller the statistical data set or sample, the more likely, the more volatile it will be, and the more likely it would bounce from 1 to 10. Individual stocks do that. Stocks that spend a lot of time at 5, that tends to be a blend of value and growth. Apple, Microsoft spend a lot of time there. Stocks that bounce to 10 tend to have momentum. But you put all this together, and that is demand. And so we watch what is the long-range effect? Is demand bouncing? Is it giving us good entry points and showing good sustained demand, like Brian said? Or is it beginning to decay? And then on the supply side, this is short volume, not short interest. Short interest is from 1974, reported 2 times a month. The Fed, the Federal Reserve, created that rule. Short volume is a FINRA articulated regulation derived from the SEC's rule called Reg SHO that modulates the modified uptick rule. Okay, so we watch that, and a lot of it is market making. And this is a very supply is a volatile measure. Demand is less volatile. So they're not meant to be perfect. You say, well, why don't you create a longer range average of supply? Well, then we lose the effectiveness of what it tells us in the short run. So we haven't done that. But that then, the beautiful thing about this is it tells us what may come. It is highly predictive. It's not perfect. But that is what demand is. And I'll move on to my next point here very quickly, but I want to show you this. As Brian pointed out, we look at whether we get entry points dropping below the green line. We've only had one since, January. We had one in January. We had a peak in January. And then we had a weak top and the whole market deteriorated. Then we had an entry point called steep bottom. And then we have not dropped below that green line ever since, but we keep decaying, right? You can see that the tops are weaker and weaker and weaker. Now there are exceptions. I'm taking a central tendency here. So what do we know? Well, the market is not going to behave like it did back here, right? If you have really strong demand, that's like firing a rocket and it carries the vehicle for a long time. But if it doesn't have another one of those, at some point there's going to be a consequence. And so it's not perfect, but it really helps us to see how things are going. So then what we do is we say, okay, well, demand is really deteriorating. Let's go down and check the supply side. Well, that declined too. Well, that lengthens the staying power of whatever gains they are, but it doesn't fuel it. A decline in the supply in the market does not necessarily boost prices. It gives it some more stability. But that's the importance. And it's a very helpful risk management tool to know in your longer range portfolios, should I be putting capital to work now, more money into the equity market? No, no, you shouldn't. This is where you want to put money to work in the equity market. And we have not had one of those. I want to point something else out and then I'll stop on this topic and ask questions. We're here to answer questions. How would what's the difference between an entry point and a big warning sign? Well, they're the same things. You get the same signals. Let me back up a little further. And here's what I mean. That we had that long pandemic boom, and then we finally broke below the green line. Short-term entry point, you got gains, but it was also the first time this had happened all the way back to in November of 2020. Okay, well, that might mean a change in the cycle. And son of a gun, it was. And then when does the cycle end? Maybe the last time it does that. So then, here it broke down, and then we didn't really have those kind of breaks a little bit, but they weren't like that again. Here you really got you got these two breaks below the green line, and then we had a nice run, then a break. Okay, well, now the conditions in the market change. So they just help us to know things are changing. And notice we have not had that. But what is the probability we get? Well, I don't know. I don't know what that is. We can measure the amount of time we go before breaking down below one and say, what's the central tendency there? Is that a good predictive indicator? No, but we look for the event. That's what we do. And we know that the risk of one of those events is rising, which leads me to another thing. I had written in the market desk note, I said, you've got demand at 4.2. If 5 is balanced, what is 4.2? Negative. Even if it's bottomed, it's been there for 2 days. It is a bottom in the sense that it hasn't fallen any further. But here's something interesting. So if it's at 4.2 and then you come and look at the supply side and it's starting to tick up. This runs in 7 to 9 day cycles. So we know we can count at 1, 2, 3, 4, 5, 6, 7. Well, is it going to stop? Yeah, it did. I don't know why it's that way, but it tends to run that way. And I'm sure it has to do with models, market making models. Now it's rising. So let's call it 50%. It's 49.9. Okay, so demand is very weak and supply is starting to trend up. Then you come over and look at the one ETF that we have on the platform, because otherwise it would distort all the outcomes. ETFs do not behave like stocks. They're like a tokenized currency. They're meant to trade in place of the underlying basket. So they depend on the underlying basket. You can't take your ETF shares and take them to BlackRock and redeem them for anything. You can't. Morgan Stanley can't, an authorized participant, but it has to do so in very large blocks. They're a substitute. So in some ways they behave opposite the basket. So you watch that. right? We will look at SPY as a proxy for derivatives. What are derivatives doing? Well, it's going to be at 5 all the time, until it isn't. And we look at the supply side, and it has declined, and it's at 50. They're identical in a sense. They're both at 50%. All right, well, if there is an arbitrage mechanism, which way do you go? If you're trading the ETF versus the basket, which is what Jane Street does and made $22 billion doing that last year. They're pretty good at it. If you can take a basket that moves 2% and you trade it against something that moves half that and take the spread, it's a really good business if you have the powerful computing systems necessary. And they make a lot of money doing it. But now suddenly it's difficult to calculate which thing are we long and short, right? Plus you've got weak demand in the market. Well, what might you get out of that? A big dip. That's what can happen. Can't tell you precisely when that's going to happen. But it prompted me to, have a leveraged short position because I got, and it's hedged with the long position because I don't know, but I know the demand is negative at 4.2, even though it's bottomed, and the supply balance is equal. Well, it's not a great situation if you consider the holistically how the market works. It's not one thing, it's 4. And 3 of them are 90% of the market, and stock picking, which is looking at these great fundamental results of public companies, is 10% of volume. And it's only functionally about 30% of assets under management anymore, believe it or not. Everybody's following models. So you think about those things, and it leads us back to the one last thing I want to cover, and I want to show you something to finish, and that is why October 10 was such a big deal. So here it is on our screen. October 10 is one, believe it or not, one of the most volatile days in the entire data set. you got, it's like you're driving down the road and all of a sudden there's a knock in your engine, and it shudders, and then it goes away, and you go, I wonder what that was. That's probably you should go see a mechanic, right? Because it's not just a one-off. Something happened, and it's going to manifest again. The market is incredibly dependent upon staying within a very narrow range. We call it the 1-2-3 rule. That SPY has volatility, highest to lowest intraday prices on average of about 1%. The market over time, by the way, returns about 4 basis points. If you run a long range comparison of how prices behave versus midpoint is the benchmark, the average. 25% of all market volume occurs in the final 30 minutes because that's the reference price, the average. That's what BlackRock, Vanguard, and State Street need. There's so much we could talk about with regard to the mechanics. But when you suddenly have a rupture in that delicate balance, because that feeds through to the basket and the derivatives, the puts, the calls, the futures. Now, what happens to all the people who are hedging gamma, the change in the price of options, delta, the speed of the change in those options, or anything else? Well, the cost is going to change. We had an anomaly. Now, how long is that going to take to remanifest in the data? Well, it was right into options expirations. You could go, well, probably just ahead of options expirations again. When would that be? Next week. Okay, because all of these things are things that you have to think about as context. October 10 mattered, and it's part of why we have snapbacks in the market. If you can sort out the cost of hedging, the market instantly recovers. If you can't, it does not. You need someone to take the other side of your trade. If you're supplying a leveraged synthetic ETF, exchange traded fund, backed by a basket of futures and options derived from the underlying stocks, so that people can get 3 times the return of Tesla, who's willing to do that? Well, somebody who can calculate the risk associated with it. And what causes that risk to become incalculable? Sudden price changes do. Right? So we watch those things. It's why we said in December of last year, we said, well, there's the beginning. This was the beginning of whatever event it was going to be. And it was one of the most volatile days we had seen right here. That was right at options expirations. Jay Powell was speaking, and the Dow fell more than 1,000 points in about 45 minutes into the reference price. So we said, okay, that's the beginning. And then we had this. So then that fixed it. Now here we are again, and we've had this. Now I don't know what's going to happen, but I've always said there'll be another shoe. You just have to be aware of these things, right? It's just how the market works. And so we watch that. You can see it manifesting in our model portfolios. That's why we launched the Focus Low Volatility portfolio, because we looked at this and we went looking at the performance chart. It stopped working about August 10, you could say, right? It just thereabouts. I mean, it had a deep drop here, but then it recovered and it stopped working. And we've been using. I'm not right now. I'm not in either of these portfolios because of my general concerns. But you would take that and say, well, what does that look like? Well, it doesn't look like any of this. It looks more like that. Now, it doesn't look exact. I don't know what's going to happen. I don't know. But it certainly isn't delivering these just cookie. We were up to 50% year to date, right? Now the low volatility portfolio has done very well, but it's only got 3 components left. It's running out of stuff to consume. It's returned almost 60% by trading standard deviation between demand and supply in stuff with less than 3% volatility, so that we don't have a whole lot of risk. But it's simply running out of stuff. So I think both of those are warning signs for us to say, well, okay, well, what's the best thing to do under those conditions? Well, maybe we should be sidelined. I mean, it's easier to have money to deploy than to lose it, And I can speak from experience. I've done both. They made money and had gambits that did not work, and it's not worth that. As we always say, take gains, not chances. Let the data inform you, because it is telling you what's going to come. Okay, Brian, let's shift to what's next. Questions, comments, thoughts, observations, please interject. We're almost finished.
One question from Brad. Brad's question is looking at chart patterns, looking at things like head and shoulder or different things like that. A lot of these patterns are evident in the rear view mirror, but does that kind of pattern show up with edge? And to me, Tim, the answer to that is the green line and the red line. We don't necessarily look at technical patterns with sentiment, but we do historically have a lot of great data when it comes to moving below the green line, which becomes a buying opportunity, or moving above the red line when the market gets stretched. And maybe you have something in addition to that.
I would add, and I've mentioned I've said this before, I've said, how many rich technical traders do you know? I said this to the head of data products at Interactive Brokers, and he said 3, no 4. So I know a couple people who have been successful, and maybe you are. But to me, there are 2 core problems with technical analysis. Number one, they consider all prices to be equal. They are not. A price set by passive investment, and John Cook, I know what you're going to say. I'm simply saying that the price the price is tied to the purpose and time horizon, and we incorporate it into demand and supply. So they're not the same. That is a problem. And number 2, all prices, for all intents and purposes, are set by a purpose and time horizon of a day or less. Nearly all prices in the market are set by firms like Citadel. I just use them like Kleenex, like a type. They are high-speed firms who have all the data, whose servers are closest to the exchange servers. They buy the proprietary data feeds that are faster than the data feeds you and I use. I buy real-time data. It's slower than what they have. Okay, so they're always ahead, and they set the prices, and they want to be out at the end of the day. Well, how could you rely on the patterns that creates for any lasting predictive capability? I'm not saying it doesn't work here and there, but I would say I would challenge you to show me that it's better than a coin toss, a coin flip, whereas we calculate probabilities in our daily trading ideas, and they're very good, right? There's a very high probability that those things will produce returns. By the way, we have added downloadable data from Broad Sentiment. It's in test. But I've green lighted it's not fancy, but it's a way for you to look at these trends if you like. So that's my problem with technical analysis. I'm not a fan of technical analysis. I've been trying to get Schwab and Robinhood and Interactive Brokers to offer traders something else Those are things that were created in the 1980s. We didn't even have an all electronic market until 1986, the Cincinnati Stock Exchange. And yet, all like Bollinger Bands, all that stuff predates that. Well, how could that be a good tool to use in today's market? Whereas demand and supply, this is all Reg MS predicated data. This reflects how money behaves at this instant in time. And it's not technical. Technicals are incorporated because some portion of the audience is using them. And they're going to be a factor into how prices behave. But that's how I think about it, Brad. And you've been successful with it. I know you have. Okay, we'll hurry to a conclusion here. Ahead. Brian, what's your 25-word answer? Joe, you're welcome. I'm sorry it took so long, and we have a couple more things coming. I have my hand, we're very careful about our development budget, and I've said that over and over, but we have some things that we're working on. We have a lot of data science on the corporate side that we've been working on. Sorry, Brian.
No, you're fine, Tim. One other thought from Brad before I look at the path ahead. He's asking if it's possible to stack the price and sentiment versus overlay, just in terms of being able to read it.
Yeah, I talked with our chief engineer on that, and could you toggle it like on and off? And certainly we could. Just realize that anything like that costs us thousands of dollars. That's why I'm very careful about it. Right? So you can say any single engineering endeavor costs thousands of dollars. And so I weigh them very carefully before I do them. Even though Edge is doing well, I'm very happy with how it's performing, right? I'm not putting money into it. It produces a return. So, but we're very carefully managing this. And that's my answer. Yes, we could. We will weigh it.
Sure.
As to my look ahead, I don't know that I could add to it. I just, I feel like if the data tell us as they are, like if you have the momentum portfolio deteriorating and the low volatility portfolio down to 3 components when it should have 5, those are things telling us the machines, the quantitative data, math, is struggling to find good things to tell us to own. All right. That's pretty simple for me to say, okay, well, be careful. Daily trading ideas tend to work all the time. I still think when demand is negative, you should be careful. So where I am now is, I'm taking very careful because it's an inflection point again. We're at I do it at the tops and the bottoms. At 4.2 with supply rising, I think that's not great. And big tech deteriorating. So I might play a carefully hedged long short play, which is what I'm doing. Today, it's very profitable. It's like up 10% today. So, but that doesn't mean it can all go away tomorrow. So just be careful here is my adage, or admonition, rather. That's all I got. Any concluding thoughts? Yeah.
I'll touch on one topic with John Sebastian real quick. A lot of movement today, but rather little relative volume. What does that mean regarding what the machines are doing or not doing? A lot of times what that means, and I'm a former buy-side trader, John Cook was a trader as well. From a trading perspective, it's basically like traders sitting on their hands. They tend to sit out volatility, so that's going to reduce just a lot of the volume on a particular day. So to me, that's part of what's happening today is active investors just tend to sit it out.
Yep. Good one. I say we wrap up, give you the rest of the day back. Beautiful day here in Steamboat. Thank you very much, everybody. Brad, I'm happy to thank you for the kind words.